there's no real playbook the Fed had. They all had a mandate by the governments to just throw shitloads of money at it and don't let the whole system collapse when they're shutting off the economy to fight what they perceived as a pandemic worthy of doing. Whether, I know there's a lot of people critical of the pandemic and vaccines and stuff. I don't want to even get political in that. Bottom line is the governments felt they needed to shut down things, and they caused so much damage that the only reaction function is we need to throw money to kickstart everything up.
Good day, empowered investors, and welcome from 189 countries worldwide. We're glad to have you. So today, our guest will be Patrick Ceresna. He is co-host of the MacroVoices Podcast. You've probably heard his name. I've shared the stage with him a couple of times, and he is here to talk about some market insights, more from my options trader or Wall Street perspective, macros perspective. I think you'll enjoy the interview. But before we get to that, a few things to cover here. So first of all, interest rates. Well, no, we're not going to talk about interest rates. We're going to talk about something different. This is a different but very important component of mortgage financing, and that is the Mortgage Credit Availability Index, the MCAI. We've talked about this on prior episodes, and it is down. Yes, it is down, meaning it is harder now to get a mortgage than it used to be. I'm sure that's not going to come as a huge surprise. Yeah, I know, it probably doesn't. But here's what I mean by that. There is an important distinction people have to make between interest rates and housing affordability and the ability to qualify for a loan based on the usual things like credit score and debt to income ratio and the DTI and stuff like that, right? There's just a general overriding concept of credit availability, not directly related to interest rates. This is the willingness of lenders to lend and the ability of borrowers to borrow. And this index fell last month. And here's what it looks like. If you're watching on video, you can see this. You can see that leading up to the Great Recession, now we're 14 years out of that. We saw mortgage credit availability rise dramatically going into that, meaning lenders were getting too darn sloppy and they were making loans to anybody who could fog a mirror. How many times we talked about that? Don't need to cover it again. And then you saw a massive tightening as mortgage credit availability just fell. It just plummeted dramatically. Tightening that supply of mortgage credit. And then, of course, we had the Great Recession and the mortgage meltdown, and we all know what happened there. And by the way, a lot of people talk about The Big Short, right? So a lot of people talk about The Big Short as the movie to see or the book to read, right? But I'd actually recommend that you see the movie Margin Call. I actually think that one is better, and it's just really such an inside look at what happened. Margin Call, if you haven't seen it, be sure to see Margin Call. It's available on all the usual places you can find it, but make sure you see that. So let's zoom in on this chart, because this is a long chart going back to 2004 on up to present day. But what we really want to do is we want to look at the more recent history. And by the way, the index really starts in 2012, where that's sort of the baseline, the base year, where the index sits at 100 in terms of mortgage credit availability. Now, right now, it's at 119. So it's not lower than the baseline, it's actually higher than the baseline, meaning there's more credit available now than there was back in 2012, 10 years ago. So that's good. But there's not as much as there was in, say, 2019, 2020, and certainly not as much as there was available back leading up to the Great Recession, where it was just too sloppy, way too liberal, and of course, resulted in very big problems. But let's zoom in on this a bit. Now, I apologize if you're looking at the video, the chart is blurry because I zoomed way, way in for you. But we can see recently, that, this credit sort of bumped along since October of 2020. It kind of bumped along the same sort of range where credit was, pretty steady in terms of that. But before that, it was much higher, and it ramped up into 2014, 2015, 16, 17, 18, 19, where it kind of peaked, and then it fell, and it sort of bumped around that mark now. But the important point to look at is, so many people look at the money supply. And since we are in a credit-based economy with a credit-based asset class, real estate, it's important to not just look at the money supply, but the credit supply. The credit supply is extremely important to look at. And that is why looking at the MCAI is really important. I will continue to report on this for you so that you're informed about where it is going. Also, to our members of the Empowered Investor Inner Circle, now called Empowered Investor Pro, we are so excited to launch the new platform we have. This is going to make it much easier for you to access content, find the topics that are really important to you. And if you haven't received an email already, you probably will today, inviting you into the new platform. You're going to love it. This is super exciting and a lot of good stuff there. You can see how beautifully the content is indexed, and all the videos from the archive, which we used to keep on a separate platform, are now all in one place for you. Super, super easy to access all of our member Zoom meetings that we have, at least one a month, but lately we've been doing a lot of bonus member Zoom meetings, and all of this will be much easier for you to access in here. If you want to find posts from other members, or they posted about a question of, best property management practices in Memphis or Indianapolis or Cape Coral or Tampa or Dallas or Houston or whatever, or the best contractors, the best handymen, the best HVAC people, whatever, in these markets where you can get the best prices and save money, best painters, best flooring contractors, whatever it is you want, questions, comments, answers, resources, all much, much easier to access in our new platform. So we're super excited about that. For members, be sure you look for that email probably today if you haven't received it already, inviting you into the new platform. It's going to be great. You're going to love the resources there. If you're not a member of Empowered Investor Pro, just go to empoweredinvestor.com and be sure you sign up. This is our low-cost, mass market, super high resourceful offering for you. Really, really good. Just go to empoweredinvestor.com, join the community, get all of the resources. You'll absolutely love it. Now, you'll love this too, probably. I love it. I don't know if you love it, but Wall Street is the modern version of organized crime, as I've said for the last 18 years. And it's great when our government does something about it. And a lot of this is just window dressing, folks, because these things, they're just a drop in the bucket for these companies that are ripping off the world. You know what they say? If you have a gun, you can rob a bank. If you have a bank, you can rob the entire world. and that is certainly true. Now, we need all of these institutions. I'm glad we have them. I'm glad we have Wall Street. I'm glad we have all of this. I'm glad we have investment banks, but they are not capitalist organizations. This is all cronyism. It's lobbyist. It's a scam. We all know that. So the balance of power needs to be kept in check always. And this is one of those times where at least there is a little inkling of that. Again, the money is, it's like, hey, you're going to give me $10, right? Big deal. I can't even buy lunch for $10 anymore, right? But at least we see this. And, I'm glad to say hats off to the EU. I don't love the European Union. I was actually in favor of Brexit because there's this unaccountable kind of bureaucracy. But I will say it does seem like the EU takes better care of its people in suing these tech companies, finding these tech companies, finding these big banksters, these big financial institutions that are just cheating people. And, they also do a better job at the food supply over there. And what I mean by that is regulating the food supply. Now, look, I'm not a big fan of regulation. You know that. But we have what we have. I'm practical. So the food supply in the United States is poison. We've been sold down the river by lobbyists and special interest groups and, Monsanto and all the big agribusiness, right? If we had a bunch of smaller companies, if we didn't have this consolidation of power in any industry, everything would be much cleaner, better. People would be able to vote with their pocketbook. They would be able to vote with their feet. And ideally, in a free market like that, the most righteous players would win, and the most disgusting and awful and evil and unethical providers and players in the marketplace would lose out because consumers would get to vote. But sadly, with big business and the corporatocracy, we don't really get a clean vote like that, whether it be tech companies, food companies, big agribusiness, big banksters, whatever it is. That's the way it is. And that's why we need to support smaller businesses and always push back against the corporatocracy. So to that end, Citigroup, Goldman Sachs, and Bank of America, by the way, I did not mispronounce Goldman Sachs. I'm being snarky again, Goldman Sachs. And Bank of America are reportedly in discussions with regulators to pay around $200 million each in fines over failing to monitor employees' use of unauthorized messaging apps. The settlement amount paid by Morgan Stanley and JP Morgan is being used by authorities as a yardstick for the industry, with the other three banks in talks to pay a similar figure. Now, again, this is a drop in the bucket for them. It's nothing. It's just part of their business plan. And you know who really pays it, sadly? The shareholders actually pay the fine. The executives don't pay the fine. And this is part of the problem with the way the corporatocracy is set up. Sadly, it is what it is, but at least, if nothing else, it's some window dressing. But the messaging apps, I just want to address that for a minute, because what these players do is they use messaging apps like Snapchat, for example. I know you think Snapchat is for teenagers, right? Or 20-something Zoomers. No, the Wall Street bigwigs use Snapchat because the messages blow up. And when they're committing their unethical, sleazy behaviors like insider trading and all this kind of stuff, they want those messages to evaporate. They don't want them to be able to be found when some regulatory agency comes in and wants to find out about the accounting scams they're using or the insider trading schemes that they're doing. They want the messages to disappear. And that's why these unauthorized messaging apps are an issue. So, hey, look, it's better than nothing. At least they'll pay $200 million. If you're not following me, by the way, on Instagram, I have been growing like crazy on Instagram. For those who do follow and comment and participate there, thank you for following me there. I'm over 75,000 followers now. It's been growing by leaps and bounds. If you want to see bite-sized content, follow me on Instagram, TikTok. On Instagram, I'm Jason Hartman and the number 1, Jason Hartman 1. On TikTok, Jason Hartman ROI, Twitter, Jason Hartman ROI. And we got to get these names to be the same on all the platforms. But we really do have some nice bite-sized content clips that are really quick, fast to listen to or watch there on TikTok and Instagram most specifically, but also Twitter. And you can follow me there for different kinds of content than you get here on the podcast or on YouTube. Okay, one last thing before we get to Patrick Ceresna. This is what I've been talking about for 18, 19 years, and it is King Dollar. Yeah, I know. It's counterintuitive, and I know Peter Schiff and all the rest are going to, disagree with this, right? Like they do. But they have been wrong over again, and I've been right over again. So, as you know, last week, the euro reached parity with King Dollar. Now, the euro has always been higher than the dollar pretty much. I mean, most of the time. I remember going to Europe many times over the years, and everything seemed really expensive because the euro was $1.30 to get €1. Well, now it's at parity. So Americans are getting a huge discount, or any dollar holders, frankly, getting a huge discount on European imports. So that's good for their export business, but it's bad for the people there because they experience less buying power. And for Americans, we experience more buying power. And the dollar has just risen, as most people said it would crash. Yeah, I'm talking about Peter Schiff and all of that clan who has just been wrong about the dollar for so much time. Now, what's interesting about this is that we in the US are experiencing massive inflation, right? So we feel that the dollar is going down in value. But what is the Jason Hartman question? Well, you know what it is. It's compared to what, right? So this is bad for our export business because other people that want to buy American products have to pay more for them based on their currency that they have to trade for dollars to buy the American products. But for Americans, it's a good deal. Now, it's high inflation here at home, but it's higher everywhere else mostly. So we think it's bad, but compared to what? It's better here than elsewhere. And I think the dollar is going to maintain relative strength. That's the important word, relative. Think of Einstein's theory of relativity as it applies to the power of the currency. And the dollar is the most powerful currency. And I say it is going to be that way for a long time to come. Yes, all fiat currencies are a race to the bottom, but all you have to do is win the race against the other currencies. That's how you win. And American hegemony is going to be in play for a very long time. All of the detractors of the dollar and of the United States are just going to continue to be wrong. So there you go. There you have it. Okay, so back to this. Europe, the precipitous decline in the value of the euro equates to roughly a 15% discount from the same time last year. And look at this with a big green arrow here, right? The flood of capital into the US for the safe haven currency. Wow, the safe haven currency. And to take advantage of rising interest rates could tame inflation as a stronger dollar makes for lower import prices, right? So our imports got cheaper, right? And that will cause downward pressure on the inflationary spiral. However, the dollar's rise is a double-edged sword as emerging economies holding American debt are now paying a premium. Folks, this is the flip side of my trademark strategy, inflation-induced debt destruction, right? Because the dollar is stronger relative to their currencies, so the burden of other countries' debt denominated in dollars, dollar-denominated debt, just got a lot higher. That's bad for them. But Americans holding mortgages on investment properties are still, at the same time, getting the huge advantage of inflation-induced debt destruction. Think about this. The official rate of inflation being 9.1%, according to the government. We know that's massively understated. It's probably about 17% in real life, or at least in my opinion. But let's go with the government number, the understated number of 9.1%. If you have $1 million in mortgages, just from inflation-induced debt destruction alone, nothing else included, and say these are on income properties, on investment properties, you are getting a $91,000 a year freebie, a payoff. Your mortgage balance of that $1 million in 1 year is $91,000 less. How much do you make at your job? Do you make $91,000 at your job? Do you make $180,000? Okay, great. So basically, half of your salary If you make $182,000, for example, half of that you got for free. It's like getting a bonus of 50%, right? In inflation-induced debt destruction, a $91,000 annual bonus if you have $1 million in mortgage debt. If you don't, you didn't get anything. If you have zero mortgage debt, you didn't get anything. Hey, Dave Ramsey, you've been really misleading people about this. Oh, Dave Ramsey, gosh, he just doesn't get it. But he's good for the market that he serves. Just stop listening to Dave Ramsey if you're an investor. It's fine. If you're drowning in consumer debt, I think Dave Ramsey can teach you some very good lessons. But when it comes to investing, he's just clueless. He doesn't get it. And Sam Zell gets it. By the way, our investment counselor, Evan, you've heard Rabbi Evan on the show before. He's one of our investment counselors. He sent me a great video with Sam Zell talking, basically, not in my words, inflation-induced debt destruction, but basically pointing out the same exact strategy. So there you have it, folks. Go to jasonhartman.com if you need any more assistance with anything. And let's get to our guest today, and that is none other than Patrick Ceresna. Here we go. It is my pleasure to welcome Patrick Ceresna to the show. He is coming to us today from Lisbon, Portugal, a great place. He is the co-host of MacroVoices and also the host of Market Huddle, and he runs big picture trading. Great to have him here. Patrick, welcome. How are you?
Oh, Jason, thank you. I'm doing great, and I'm honored to be on your show. Thank you so much for having me. Looking forward to a good chat.
Well, the pleasure is all mine. You know, we shared the stage in January in Houston at George's conference, and I've been wanting to get you on the show for a while to just get your big picture outlook. I'm almost glad, Patrick, we waited because more stuff is happening now than was then. So yes. Give us kind of just your take on the macroeconomic picture. People are concerned. It's a time of transition.
Rightfully so. Yeah, the concern is correct. I mean, we are in the midst of a bear market on asset prices. It may not have fully reflected into the real estate markets yet, but in terms of stock markets, bond markets, even slowly into commodities and other things, there have there's asset deflation, a deflationary cycle in assets while there's huge economic inflation, and that's because the central banks have begun a very important process of trying to attack inflation by slowing the economy, and the only mechanism which the central banks have to slow an economy is the cost of credit, and reflected in interest rate policy. And so one of the reactions that occurs is that as we make very large sums of money through assets, through purchases and stuff, we feel more confident to spend, and therefore the spending leads to more demand, and more demand leads to inflation. And so the natural response mechanism is, well, we raise interest rate, raise the cost of credits, stress asset prices, and byproduct would be generally a slowing demand, which will alleviate inflationary pressures. The problem in this cycle, and why you have the debate of inflation, stagflation, or deflation, is that when the inflation is not driven by massive demand, but rather supply issues, then actually the ability for monetary policy to actually have an impact diminishes. And I find that this is the interesting part that we find ourselves. We're at a situation where one of the key precipitating drivers of inflation has been substantially rising commodity prices, whether food prices, whether it's oil prices, all sorts of different commodities have been running. And that passes on to the ability of producers, what they pay, and then they have to eventually pass that on to the consumer through consumer prices. And the cost of these commodities, the most important one has got to be oil, and generally energy is an input variable into everything. It takes some form of energy to create anything and everything. It takes a certain amount of energy
services.
and service, including this podcast, takes a certain amount of energy. And the thing is that when you have governments around the world that prioritized, and I'm not saying this with a huge political bias, but when the focus of the political regimes is, let's say, green, which is that we need to focus on the environment, and the byproduct of that is to try to reduce the oil's part, or fossil fuels and that type of energy as a part of the economy. If you have not made a healthy, replaceable energy to take its place, you create energy shortage. And that is where we find ourselves, where it is a dirty business to be in the oil business. It's like owning tobacco back a couple of decades ago. Right. Like the idea of owning oil companies in your portfolio is dirty and you're bad and you're the reason that
there's this ESG movement. And
exactly. Right. And so what happens is that the normal response mechanism is that as soon as oil goes up, everyone fires up the wells. Everyone throws huge money at these energy companies. They start investing in all sorts of capex and building things out. And suddenly the cure for high prices is high prices. The demand, the supply comes in to meet it, and you have a cyclicality. And the response this time is actually so muted. The high oil prices is now have us simply begging OPEC to just make more, because there hasn't been a response in the developed Western world to produce more oil. And now that we have geopolitics come in, and you suddenly are routing Russian oil through China and India as opposed to taking it through Western borders, you've created all sorts of supply shocks that add further stress points, that create additional costs, delays in shipping, and all sorts of other issues that make this a problem that's not going away, and it's not going to be solved by the Fed putting another 75 basis points next month. It's this is a problem where inflation has to be solved by a bigger cycle playing out, and that unfortunately is not one that ends in 3 months. It's one that ends it over a couple of years, and so this is an issue that's not going away.
So the issue being inflation, right? Inflation is not going away. Is that what we hear you saying?
Inflation is not going away. And more importantly, the Fed's ability to bring inflation down is also going to be substantially muted. Now, there is one positive thing that's going to happen is that the nature of how inflation is calculated. So let's say, where I'm just going to throw the round numbers. Okay, we're running a 10% inflation. We're not. I know that that's not exactly what the number is, but let's say we're running a 10% inflation. And in order to create 10% inflation, it required oil prices to rise from $50 a barrel to $100. You needed commodities rising at a certain pace to have the trickle-on effects passed on through to higher CPI. The thing is that it is a compounding effect. So in fact, to create the same next year over year inflation to be in 10% again, we would need to see oil go from like 100 to 200 in the next cycle. And so what happens is there's a natural going to be a natural slowing of inflation, simply because the rate of change of commodities is likely not to be going up at the same pace as it was in the last cycle. And so just the rate of change is going to slow, which means that CPI might come off from the current close to 10% rate, and we might see it go back to 4 or 5% or something. And then the Fed's going to do a big victory lap. Look at us, our policy is working. Right. We're bringing inflation. But it was just a natural effect of just the way the numbers are calculated and the way it works. Inflation will come off. We probably are close to seeing peak inflation levels for this stage of the cycle. If you think back into the 70s, there was 3 waves of inflation. Each time it peaked, it started coming off, and then another cycle came in, peaked, came off. It's like the stock market. It goes up, corrects, goes up, corrects. It's just a normal process. And inflation will do something almost the same. You're going to have a scenario where we probably are seeing the short-term peaks and the fact that there will be likely an economic recession, whether it's a technical one of 2 quarters of negative GDP, will probably not, maybe, but we are going to have the recessionary effects of higher interest rates. There's going to be larger default rates on certain companies. The cost of credit will rise. The consumer spending will come off. All of those things are going to happen, whether it's officially technically called a recession, as we'll see. But we are going to see that. And I mean, you can see that in real estate too. Not that real estate prices have massively dropped, but housing sales are themselves are coming off. The amount of time that real estate sitting on the market is increasing. There's a lot of those things of where a cold bucket of water has been poured on the markets, and generally the momentum that we saw is dissipated.
Yeah, and it's long overdue. I think I'm really critical of the Fed. I think they let the economy run way too hot for too long. They should have done this sooner, and they should have done it more gradually. Am I wrong on that? Do you agree? What do you think?
I agree, but it was such a unique thing what happened with COVID. There isn't too many historical precedents where we had a global pandemic, where the world is one massively integrated economic machine, right? All intertwined through the G20 and the way all central banks now interact in this globalized world, and to have the entire system simultaneously shut off because of COVID. It's unprecedented. I don't think there's any history that we could show that this happened on a global scale. You can find it where it happened on an individual country, but not where the whole world did it at the same time. So there's no real playbook the Fed had. They all had a mandate by the governments to just throw shitloads of money at it and don't let the whole system collapse when they're shutting off the economy to fight what they perceived as a pandemic worthy of doing. Whether I know there's a lot of people critical of the pandemic and vaccines and stuff. I don't want to even get political in that. Bottom line is the governments felt they needed to shut down things, and they caused so much damage that the only reaction function is we need to throw money to kickstart everything up. But the opposite happened was they flooded the system with so much money. I love that giving an analogy, Jason. And so the analogy I would give is imagine a bathtub. And COVID punched a massive hole in the bathtub, and the water started leaking out on the bottom at a huge pace. And so think of the economy as the water level started dropping rapidly in the bathtub, and came in the Fed with money printing, which was we're dumping huge buckets of water into the top of the bathtub to attempt to bring the water level back to where it was supposed to be. The problem and the debate everyone's having is they poured way too much water and the bathtub's overflowing now from the top, right? Mm-hmm. And the thing is the Fed is a reactionary organization. They don't do a lot of things preemptively. They do things in response to things that need to be done. And so we can be critical, but I mean, I like to think of it as a trader, as a macro investor and things like that. It's just about understanding what they've done and the implications so that I know how to put my money to work. Like we can debate until we're blue in the face. They should have done this, they should have done that. But really, I think the bigger thing is, what does it mean that they did do it? And how do we make money off of it? Or how do I protect myself knowing that there's dangers out there? And I don't want to have a huge impact on my wealth because I'm in the wrong things at the wrong time.
Yeah. Okay. So that's a great segue. What are the answers to those questions? What do we do?
Well, I love that saying where the winner in a bear market is the one who loses least. It is there isn't some secret sauce of that there's look, you could be a short seller and you could be short the market when everyone is losing, you're making, but that isn't a natural place for the average investor to go, right? That's an arena for sophisticated investors that feel that they can actually actively manage a short position. So I don't feel like I want to introduce that to this conversation that, hey, you just got to be short, right? So the question is that in a natural investor process, what do you own in an environment like this? Well, those things that I own, I tend to like to express through some form of a convex way using options. I love the convexity of owning an option as a stock replacement on long-term options. Without going into the complexity or the technical jargon that's associated with it, what the easiest way to describe an option is the more right you are, the more the option behaves like the underlying. So if you have an option on the upside of the US dollar or on the stock market, let's just say the S&P 500, the more you are right, the more that option behaves like if you were actually invested in the stock market. We call that the term, the options delta is approaching one. I'm not, the offset to that is with an option, as you are wrong and it goes against you, the rate of your loss slows. And so what happens is that the more and more you're wrong, or like in the stock market, we like to say you're early because no one wants to admit they're wrong. So let's just say you're early and the stock keeps going down. But the more you are wrong and it's going against you, the rate of your loss actually is perpetually slowing and you're losing at a less and less rate. Now, that in itself, everyone can say, well, an option means I could lose everything. If I put all of my money into an option, the option could expire worthless and I could lose it. But I don't like to look at options that way. I like to own options as a way to replace my stocks. And so if I, let's say, was already willing to own $250,000 of Apple stock, if I buy $20,000 of call options on Apple, that is giving me $250,000 of notional control of Apple stock, then I have $230,000 I didn't put into Apple stock that is sitting in cash on the side. Now, I am not actually using the option for leverage. I'm using the option as a stock replacement. Now, what happens is that if Apple loses 30 or 40% in a bear market, I'm not done $100,000 on my $250,000 investment. I'm actually really at the worst case down 20,000, still sitting with 230,000 in cash. And this allows me to try to find where a market bottom is. Not that I'm guaranteed to always work, but I can manage my risk, I can define my losses, and I can manage my way through the cycle without knowing the risk of the fact that I could take extraordinary losses beyond what I was comfortable with. Because when I'm put on a trade, I always know what my worst case loss can be up front. And therefore, I can define my risk reward propositions in my trades using them.
Right. So that's the personal level for the investor. And, a lot of our listeners understand that. But I want to ask you a really broad question, Patrick, that you made me think of as you were talking about that. We all hear these crazy, insane numbers about the derivatives market. Okay. Yeah. And, certainly you've heard them too, and how this could just crash the global economy because there's quadrillions of dollars or whatever in derivatives. And, I've never really related to that. And, I don't know enough about it to know, but, there's always a counterparty to every transaction, right? So it's not like the whole wealth just evaporates if something goes sideways. It just changes hands. I mean, talk to us about that.
When you hear a stat like there's $700 trillion of derivatives out there, or some astronomical number, I would say 99% of those derivatives are incredibly insignificant to risk. Like, for instance, if a Japanese bank and an American bank each have a certain amount of certain currency on each other's on their own balance sheets, and the one bank needs to make a loan in another currency, and they create a swap where the derivative swap between them, saying, we need some of this currency. It's you create some sort of a structure where the money is temporarily moved off of the risk is moved from one balance sheet to another, so something can be created. There isn't a risk where that entire value of that loan can be zeroed. In the end, what they're doing is just transferring, let's say, the currency fluctuation risk between the two currencies, not the notional value of the currency loan itself is at risk. And so the thing is the number is grossly over exaggerated, but the risk that they're trying to identify, which is always real, is counterparty risk. Ultimately, when you have a huge amount of derivatives existent, then what you're doing is playing a game of moving risk, for a certain type of risk, from one balance sheet to transfer it to someone else who's being compensated some degree or another for undertaking risk. So it's a movement of risk. And the thing is that in an economy, in a system that everything is working and all counterparties are liquid, then that's never a risk. But like we experienced in 2008, at the Lehman moments or AIG moment, when a counterparty risk was assumed to not be a risk at all, then when that risk suddenly appears, the effect could collapse the whole system. And that's what a lot of the doomsdayers out there are saying, is that with so many derivatives, how do you control that there cannot inevitably be one of these chain reactions of unintended consequences of one major counterparty failing, and it trickles down and creates a big effect. Now, this is always a risk. It's a part of a systematic risk. We have a complex system that is grossly huge, but it's not an American risk. It has become the global system. It is a system that involves all countries, and which makes it incredibly crazy complex, because you are now talking about the way China regulates their institutions, the way Japan regulates their institutions, the way Europe regulates their institutions. What are all these counterparties? And when you have such a complex system, inevitably, it cannot sustain forever. At some point, something breaks. Now, the thing is, I like to be an optimist and believe that the breaking of that is just a cycle. They find a way to patch it up, fix it, and then the system, just like in 2008, I mean, everyone was sure that the system was entirely going to collapse, and they threw a patch on it and figured it out, and suddenly the system started to work again. I believe that when the next crisis happens, they will find some way to fix it. I mean, look, at some point we're in a fourth turning. At some point there will be some major financial institution reset of different things, but it's probably not going to be remotely as scary as the doomsdayers want us to believe. The thing is that when a doomsdayer that's selling precious metals coins, they will spew all of the reasons why this doomsday is going to happen, and the only solution is gold coins, right? And and some other one is going to give you the same rant, and they're going to say their solution of owning this is the real way. And that's
the reality is the doomsdayers are always wrong. I mean, I remember back to the 70s, you had Howard Ruff, you had all of these people. I had Howard on my show, years ago, and it's all the same trope. It's like buy gold, and it's just the same thing.
But like, the way that I want to kind of frame doomsday is this: the governments don't want the financial system to fail. The financial banks don't want the financial system to fail. And anyone who has any half-decent net worth also does not want to see it fail. Pensions don't want to see it fail. Corporations don't want to see it fail. Who has an incentive to see the system fail? Only a few fringe people that are planning for it. And the thing is, is that when the system, for whatever reason, is introduced a variable that begins a chain reaction that starts to fail the system, nobody has an incentive for it to fail, so they will accept any draconian actions that will bring the system back to a point of stability. And so in order to bet on true failure, a true failure system is a systemic risk that is so severe that it's simply impossible to attempt to repair it. Now, what could be something like that? A nuclear war could do that. A meteor hitting the planet could do that. Some pretty extreme events can happen that would make it very difficult to repair a sequence. But if it's just some derivatives breaking, trust me that there's enough people with skin in the game at the very highest levels that they'll find a way to patch it up. It will take a pretty extreme event for the whole system to fail.
Right. Yeah. Okay. So talk to us more about what you see as the future, like how much inflation, because a lot of our listeners are essentially shorting the dollar through my inflation-induced debt destruction strategy. Do you think the inflation will start to moderate? I know you were talking on MacroVoices about lumber prices calming down, but houses are just commodities. They're all just lumber, copper wire, petroleum products, glass, steel, concrete, etc. Energy, of course. How serious do you think this inflation is going to be, and how long do you think it'll last?
I think there's different forms of inflation
Yep.
that have to be accounted for. And the type of inflation that would drive a US dollar decline and the dollar destruction of purchasing value is the underpinning driver of a monetary driven inflation, which is a risk. But that type of inflation requires a central bank and government that have just gone unhinged. And some people argue that they have demonstrated that in the last half decade, and what the actions they have taken have demonstrated them gone unhinged. But to me, I don't think we have seen governments gone unhinged. And more importantly, I also think that one must not lose the relativity of the US's situation relative to other countries in the world. And when you realize how foobarred Japan and Europe and other places are, then what happens is the US dollar is going up.
The US dollars,
US dollars going up because other countries are far more screwed. And the thing is that what happens is that because many of the listeners are American, it feels like it's your country that's the problem because you see it firsthand what's happening in your own country, and all the news is all about what's happening in your monetary policy, your government spending, your deficits, and all of these. But one at a macro scale must look at things relatively. And the US at this moment is still a very healthy place for money to flow relative to the alternative options that are available around the world. And this is why US dollar strength is the reality. And the US dollar rising right now is actually somewhat going to keep inflation in check. If you think about where in the real risks of a true runaway commodity cycle and all these different things is, think of the year 2000 to 2007, that 7-year period where the US dollar lost 50% of its purchasing value. During that period, commodities had runs where some commodities were up anywhere from 100 to 1,000% in those 7 years. And those are the kind of conditions that would really create a thing. And we don't see that type of inflation right now. Right now, it's supply shocks. Right now, it's shortages. Those things drive inflation higher. They trickle through. I think that inflation will come off toward 5%. Interest rates will eventually calm down. I don't think that Powell will be able to complete it remotely as many interest rate hikes as everyone thinks he will. And
I thought they would back off on the last one, but they just went right ahead.
No, I think there's definitely another 2-3 rate hikes coming, and we might see interest rates head toward 3+% on the Fed funds rate. We'll probably see a flattening of the yield curve from that process, but they'll just keep rate hiking until they break something, and that's why a short-term recession, a recession in the short term, is a risk, because the Fed tends to not stop until there's a reason to stop, and usually that reason is there's a shock of some sort introduced that says, "Holy cow, we've gone too far," and they have to pivot. And because of that, I think that the next, going into the fourth quarter, that's going to be a lot more of the same. And that's why on the short term, I'm still think we're in a primary bear market that has to be respected. And so right now, defense, batten down hatches, protect the investments you have through option hedges and other types of things to make sure that you're that person that loses least during one of these cycles, so that you have plenty of cash on hand, because at the end of every bear market is a once a decade opportunity to buy a lot of cheap shit that makes you a lot of money in the following decade. And the thing is that at the end of this bear market, even if it lasts another year or 6 months, is going to be one of those once a decade buying opportunities on everything. And you have to be psychologically in a good state. There's this great book. Was it Walter D? Oh my God, I'm embarrassed now. But the book is titled "When It's Time to Buy, You Won't Want to."
Right. Yeah. That's the problem. That's the problem with our psychology as people. We can't tell when we're at the bottom, and that's the point of greatest fear. And so the vast majority miss that opportunity. But I got to say one more thing though. The people that listen to Peter Schiff's advice and Harry Dent's advice, they always just miss out, because like every decade you've got, in that 10-year period, and it may not be like 0 to 0, right? In terms of the years, of course, but in a decade, in a 10-year period, you're going to have boom times, you're going to have recessions, you're always going to have that in every decade, right?
Yes.
And you just miss out on so much return by not being in the game too, though. So that's, it's tough to weigh this stuff,
It is. And you know what, there's bull and bear market cycles. And this is why I blend technical analysis with the macro, because what you need to do is step back and say, look, everything has got a cycle. There's a point where everything is working when something breaks and something goes down. And you have to have the mental flexibility to move your money around based upon where money is going. And the thing is if you just take a greater theme like a Peter Schiff would give you, this is going to happen and this is going to collapse, or this is going to
and he's right. Once every 10 years, there's a recession.
But the thing is
gold
that
hasn't done anything near what he said. The dollar has not collapsed. It's done the opposite. China has not decoupled. None of that happened.
A really good investor or trader knows when to leave a party and go to a new one. And like what happens is that you have to recognize big macro trends as they're happening. And when they fully played out, you have to be good enough to say, that was a good run. I got to take my profits. Or it's a bit like, this has been crazy. I can't believe it's this cheap. I got to go and actually own this stuff, because that's a once in a lifetime opportunity to buy it this cheap. You have to have the ability to look at things that way. And there are not enough people that are capable of it. They react to every headline they see, and they don't stop to think about it. This is why I love the name of my company, Big Picture Trading, because what we're trying to do is to look, step back and understand in the bigger picture what is happening. Because if you're like a microscope or a magnifying glass, if you're just zoomed in on the intraday volatility, it's up today, down tomorrow, and then it's just wiggling back and forth, you sometimes lose sight of what is really happening, because you're just looking too close at something that's just noise.
Yeah, you got to back up and see the big picture. I couldn't agree more. The folks just doing math and looking at charts are missing out on a part of the equation. So very good point. Patrick, give out your website.
Bigpicturetrading.com, or you can on any podcast player look up the Market Huddle and MacroVoices. MacroVoices is a little bit bigger than Market Huddle because we bring on some very high level A grade guests to talk some high level macro. But on the Market Huddle, we get into the weeds with some really amazing traders and talk some markets and market timing and other types of elements. All are free on podcast players, so enjoy them or visit at bigpicturetrading.com. Thanks for the plug, Jason.
All right, Patrick Ceresna, thanks for joining us.
Thank you very much, and have yourself a great day, bud.